All right, so here we are again. So we've got a few things to do today. First of all, we have a problem set to go over. And all right, hold on one second. Let me get it open. Oh, before we do that, let's take a quick look at Moodle. Nope, not that. Moodle. All right, and so, oh, tonight. All right, they're working on it tonight, so we have to watch out for that. Anyway, here we go. So what I've done is there is a sample midterm here now, which is going to cover chapters 2, 3, 4, and 5, as is the actual first midterm. All right, so if you recall, we've broken up this course into basically a couple of major sections. 2, 3, 4, and 5 all involve international trade. After that, it's all about international finance. So we had a problem set for chapter 2, which is all based on comparative advantage. This problem set 4 that we're about to look at is all about tariffs. And so we're going to look at that today. And then when that's done, we can get back to what we are doing, which is chapter 12. But I would like to ask everybody to take a look at the sample midterm, and so that we can go over it next Monday. And then that way, when we're done with that, I can post the actual midterm. And then you'll have, I usually give most of my classes a week to get their midterms done. So that way you'll have a full week to get it done. It's not going to take, obviously, a full week, but this way you'll have time to work on it and think about it carefully and review and put together some study guides maybe, or some notes. But this is the sample midterm. And as you can see, it has 20 short answer questions or fill-ins, all based on the chapters 2 through 5. And then it has problems that look very familiar because they involve comparative advantage and tariffs. Okay, so this will be the primary focus of the problems on this first midterm. All right, so this is it. It's there available on Moodle right now as we speak. So we'll go over this next Monday before I actually post the midterm for real. It will also be based on 2 through 5, and it'll be very similar to this one. In the meantime, though, let's take a look at the chapter 4 problem set. And when that's done, we can get back into chapter 12, for which I have, I think, at least one video today for us to look at. And we can get back to where we were, which, hold on, let me go get it open so we can remind ourselves where we were. We were looking at, right, of course. We're looking at the long-term factors that determine exchange rates. And we just started talking about the Big Mac Index. That's right. All right, so we'll be doing that in a few minutes. But first, let's get to this problem set. First, let me get this closed. And yeah, let's take a look at this thing. Oh, no, not that one. I don't know what happened to it. I had it open a second ago. Yeah, it seems to have disappeared. I'll just go open it up again. Here we go. All right, let's take a look at this. Okay, so what do we have to do first? Now, here's a table. We have a demand and a supply schedule for coffee prices in the United States. No, not the United States. Sorry, it's a small country. And so what are we being asked to do here? We're going to assume that the world price is $4 a pound. Now, if you look at this chart, The domestic price, the equilibrium domestic price, is $8 a pound. How do you know? Because at $8 a pound, you can see that the quantity supplied equals the quantity demanded. So in this country, the equilibrium price is $8 a pound. Unfortunately, though, the world price is $4 a pound, which means that we're going to find that this country imports a significant percentage of its coffee from foreign countries rather than from domestic producers. So we'd like to start by drawing these supply and demand curves as best as we can, and using that to analyze several key details here. So let's see. I guess I could squeeze it in right here. All right, so if you look at these numbers, the price, when the price is 0, the quantity demanded is 16. Okay, so let's start there. And when the price is 16, the quantity demanded is 0. So basically, this is a straight line between these 2 points. All right, well, it's okay. It's an adequate job of drawing the demand curve. Now, if you look at the supply curve, it starts at 0. When the price is 0, nothing is supplied. So here's what we have to do. We have to draw the supply curve. If you notice, they cross at $8. And at that price, the quantity demanded is 8. So this is where the supply curve will be. All right, that should do it. That's our graph. So now the one thing that's missing, in fact, I'm going to copy this somewhere else before I lose it. What's missing is the world price at $4. So we need another line. Now let's look at this chart very carefully. When the price is $4, that means that within this country, the quantity demanded is 12, but the quantity supplied is 4. Okay, so let's see what we can do here. All right, now we're all set. We've got the domestic supply and demand curves. We also have the world price. So actually, I don't need this. I'm going to copy this down below. So once we've drawn the picture, what are the equilibrium? Okay, so clearly, just by looking at it, the equilibrium price and quantity, equilibrium price in this country would be $8 in the absence of trade, that is, and the equilibrium quantity is 8 units. 8. In fact, let's think of this as, I think it says in the chart, millions of pounds of coffee. Yeah, millions of pounds per year. So we actually are buying, or we would consume 8 million pounds of coffee. Now, because of the world price being so low, though, that means only the first 4 million pounds of coffee are being supplied by domestic producers. We go up the supply curve until we hit the world price, and that shows that it's worthwhile for our domestic producers to produce 4 million pounds of coffee at such a low price. So the quantity demanded, the domestic quantity supplied of coffee equals 4, which of course means 4 million pounds, because the price is only $4. Now, in other words, People won't pay more than $4 for this coffee because they can buy it from abroad. So the domestic producers can afford to sell up to 4 million pounds at this price. After that, they would start to lose money. We also want to know what's the domestic quantity demanded of coffee. So it's such a low price. The domestic quantity is way over here is 12 million pounds. Okay, so in other words, the quantity supplied here is 4, but the quantity demanded is 12. So where are we going to get all that extra coffee? Well, therefore, the spread between the two, which normally would be considered to be a shortage, if this was a purely domestic market, this would represent a shortage of 8 million pounds, and that would require the price to rise domestically. But instead, because this is a foreign country who's charging $4 for the coffee, we say here that we import the rest. That would represent 8 million pounds that's being imported because the quantity supplied is only 4 when the quantity demanded is 12. The rest has to come from abroad. Okay, so rather than having a shortage where the price will rise to equilibrium, instead we simply buy the shortage from abroad. In other words, the 8 million pounds comes from foreign countries. All right, so is any coffee imported by this country? The answer is yes. Imports equal 8 million pounds. Okay, now with all that being said, with this setup, we need to know now the consumer, producer, and total surplus of this country with free trade. All right, so in other words, if you look at this graph right now, the consumer surplus is very, very large. It's everything from the demand curve all the way down to this world price of $4. And so that's, remember, 1/2 base times height. So it's a half. The base is 12 because we're actually altogether consuming 12 million pounds of coffee, including the imports. And the height is everything from the world price of 4 up to the 16 up here, which is 12. So we end up with 72 for our consumer surplus. The producer surplus, on the other hand, is really tiny. That would be this section down here. All right, so the producer surplus is 1/2 of the base times the height. The base is only 4, the height is only 4. So we end up with 8. All right, so that's where those are coming from. Those triangles represent consumer and producer surplus. So altogether, we can summarize this by saying consumer surplus down here is 72. Producer surplus is 8, so the total surplus is 80 rather. Okay. So far, so good. All right, nice. Now we have to make a change here because we're going to have a tariff. A tariff will be imposed by the US government, or sorry, and this is a small country, it's not the US. The domestic government imposes a $2 tariff. Why? To increase that producer surplus. All right, so what does that do? Well, let's find out. So now we need a new line in here to indicate where the tariff is. So this line, I'll draw on this new line. This is the world price plus the tariff. So we basically shifted the curve up by $2. All right, now we can go back to the chart and find out where the new quantity supplied and quantity demanded are. All right, let's do that. So at a price of 6, the quantity supplied goes up to 6. All right, so now 6 is coming from our domestic producers. At the same time, though, domestic consumers will buy less coffee. At a price of 6, they will only buy 10. Okay, so that comes from the chart. Okay, so this is our new graph. Now they want to know what is now, with the tariff, the new domestic quantity supplied of coffee. So as we just saw from the chart, the quantity supplied is now 6 right here, and the quantity demanded is 10 over here. How much coffee, if any, is imported after the imposition of the tariff? All right, well, we'll continue to import coffee, just not quite as much. Right here, you can see the spread between the quantity demanded and the quantity supplied. These are the imports, and these imports equal 4 million pounds, okay, down from 8 up here. Okay, so we have 4 million pounds worth of imported coffee. And now the fun begins. We have to recalculate the consumer and producer surplus. All right, so let's see how that stacks up compared to what we had before. So consumer starts from the demand curve and goes down now to this new world price plus tariff. So the new consumer surplus equals 1/2 of the base times the height. This time the base is only 10 and the height is only 10. Whereas for the producers, they're happy now. Okay, because you can see that this obviously is much bigger. The base for them is now 6. The height is 6. And so we have 18, which still isn't a lot, but it's better than before. All right, so now why don't we bring these together and compare them. So the new consumer surplus is 50. The new producer surplus is 18. Now they also want to know, what are the tariff revenues generated by the government? So remember, the tariffs, because we're importing 4 million units and we're charging a tariff of $2 each, the tariffs are going to be represented by this rectangle in here. The tariffs will equal, and since this is a rectangle, the area is base times height. The base is 4, the height is 2, and we'll get $8 worth of tariffs, or 8 million actually. So the tariffs are 8. So how much deadweight loss is suffered in this country? Well, all right, so the original total surplus was 80. Now, in this case, if you add the consumer surplus plus the producer surplus plus the tariff revenues, we can think of this as the new total surplus. And so again, we have 50 plus 18 plus 8 equals 76. Okay, so therefore, since the total surplus fell from 80 to 76, the dead weight loss is $4 million. Okay, so that's the best way probably to calculate the dead weight loss. Calculate the total surplus without the tariff and compare it with the total surplus with the tariff, and the difference will tell you what the dead weight loss was. If you really wanted to, you could also just come up here and say, all right, listen, the dead weight loss equals the sum of these two triangles. Okay, so if you wanted to do it that way, the dead weight loss equals the area of, I guess I'll just call them the two yellow triangles. Okay, so there'll be two triangles, each with an area of 1/2 base times height. And that will be 2 times 1/2. The base in each case is 2. The height is 2. So you'll have 2 times 2, which is 4. So either way, the dead weight loss is $4. So these two collectively give me my dead weight loss. And you can see why this has to happen, because the consumers are losing out. They're paying more money for less units of the coffee. So even though the producers are happy, and even though we have tariff revenues, on balance, the society is still worse off. And so we lose the dead weight loss. That's what's lost forever, with nothing to compensate for it. All right, so that was pretty straightforward, I think you'll agree. Well, a lot quicker than the other one, that's for sure. So, all right, so what comes next? We still have a lot to do in chapter 12, but before we do that, let's just quickly review what we've been doing. And then we're going to take a quick peek at a video. All right, so what were we doing here? We're explaining how in this chapter, we ultimately want to determine what exactly is it that causes interest rates to take on the values that they have. In other words, why are exchange rates at the levels that they are? In other words, where are they coming from? So we're going to make a distinction between short run and long run factors. And we noted that long run factors include anything that makes domestic goods and services attractive relative to foreign goods and services, because in the long run, the only thing you can really do with your foreign currencies is to buy foreign goods and services. All right, in the short run, we'll assume that prices are fixed. In the long run, prices are flexible. So prices will play a major role in the long run determinants of exchange rates. So in the short run, the main motivation will be assumed for buying foreign currencies is to invest in foreign financial assets like stocks, like bonds, or foreign bank accounts. But in the long run, the main motivation for buying foreign currencies is to acquire foreign goods and services. Okay, so what factors do we consider for the long run? We start with the long run because it's a little simpler, and we're looking at four basic areas that can help explain the long run strength of a currency. And you can see included there are the domestic price level, which, remember, in the long run, that can change, productivity, consumer preferences, and of course, trade barriers. So how do these factors affect the strength of a currency in the long run? Well, again, it all comes down to, do people want to buy our goods and services? If so, if foreigners are dying to buy American products, then we'll see a stronger dollar. If not, we'll see a weaker dollar. So if you look at the supply and demand curve, we'll do this with supply and demand curves. The US price level, if our prices rise compared to the foreign price level, in this case, the UK price level, that makes our goods relatively more expensive, which means people will buy fewer of them. Not just Americans, but the British as well. What will that do to the supply and demand curves? Well, remember, the supply of the foreign currency, the pound, comes to the United States from British purchases of our goods and services. The demand for dollars comes from the British citizens who are willing and able to buy American products. So what's happening here is that if US prices go up, foreigners will demand, our Americans will demand more foreign products, which means we need to buy more of the foreign currency to buy those products. The demand for the foreign currency goes up. But at the same time, though, the foreign consumers do not want to buy as many American products. So therefore, the supply of the foreign currency drops, and the net effect is an increase in the exchange rate, in this case, dollars per pound, which indicates the dollar has depreciated against the pound. Okay, so we have a weaker currency because our prices are rising faster than they are in the UK. All right, well, I hope that makes sense. I mean, obviously, if our products are too expensive, people simply won't want to buy them. Productivity. Now, this is the other extreme end of this. If our productivity goes up faster than the UK, that should lead to lower US prices compared to UK prices. And everything we just saw will work in reverse. In other words, our goods are becoming cheaper compared to British goods. And so we simply reverse both of these shifts. The supply of pounds will go up as the British try to buy more American goods. The demand for pounds will go down as Americans try to buy fewer British goods. And so therefore, you can see the exchange rate drops, and that means the dollar has appreciated. So productivity gains will help strengthen the currency in the long run, mainly because it makes our products cheaper. All right, so, and then as you can see, that will make our products more attractive. US preferences. This is all about, do we want to buy, Americans want to buy more or less British goods? All right, so it's hard to predict something like this, but if, for example, Americans suddenly decide that they prefer British goods to American goods, then what will happen is we'll try to acquire more British goods, which means the demand for pounds will go up. We're assuming here that nothing's changed with the UK consumers, so only that demand curve will shift. All right, so in other words, there's no change in the supply of pounds. The British are assumed to continue to buy the same quantity of American goods, but Americans, for some reason, have decided they want more British goods. And so you can see the exchange rate goes up, and that means the dollar has depreciated. Now, Obviously, this can go both ways. If the Americans change their minds and they decide that they want fewer British goods, the demand curve would shift to the left and we'd have a stronger dollar. All right, and what about this one? What about trade barriers? If the US imposes trade barriers on the importation of British goods and services, that means that British goods become more expensive to American consumers, and therefore Americans will simply buy less British goods. This is essentially the opposite of what we just saw. Suddenly, Americans are buying less British goods, although we're assuming that there's no change in the purchase of American goods by the British. So this only affects the demand curve for pounds. In a negative way, people in the US are buying less British goods. The demand curve shifts to the left. And of course, the dollar has then appreciated as a result. Because, and now, of course, this is one of the reasons for doing this. The government is trying to help domestic producers, but they're also at the same time strengthening the dollar. All right, now purchasing power parity. This is a long run condition. Now, we started to see that this condition doesn't seem to work very well in practice. This idea has been around for several centuries. And when it was first proposed, it may have worked a lot better than it does now. And so basically the theory of this is that the only thing that determines the exchange rate between two currencies is the price levels in the two countries, which means that the country with the higher prices should have the weaker currency. All right, so let me just sneak that in here. That's an important detail. According to PPP, the countries with the highest price levels should have the weakest currencies, and of course, vice versa. So this kind of makes sense. The idea is that countries with a high price should have weaker currencies. The problem with this theory, though, is that it depends on a lot of assumptions that are probably not true in practice, especially now. Specifically, it's based on the assumption that the law of one price holds for all goods. And the law of one price, in turn, indicates that a good should sell for the same price in all markets. And if we're comparing domestic and foreign markets, once you take into account the exchange rate, the good should sell for the same price in both markets. So we looked at this quick example here of the gold selling for $800 an ounce in the US when the exchange rate is $2 per pound. This implies, of course, that the gold should be selling for 400 pounds an ounce in the UK. How do I know that? Well, by the way, whenever you're dealing with exchange rates like this, you have to make sure you know whether to multiply or divide. It can be a bit of a headache. So here's what you can do. If you write it out like this, I think it's easier to see if you've done this correctly. Algebraically, what you're seeing here is equivalent to multiplying by the inverse of the denominator. And now you can see that indeed the dollars cancel out and you're left with 400 pounds, which is exactly what you were looking for. So if you multiplied by mistake, you would see that the units are not correct. So with exchange rates, of course, when we convert, we always either divide or multiply. And the best way to make sure you're doing it correctly is to either, write it out this way so you can see the units and make sure that the right units are canceling out. All right. Now, If the law of one price holds, then clearly gold should sell for 400 pounds per ounce in the UK. But what if it doesn't? What if it's less? What if it's too low? Then we could earn arbitrage profits by buying gold in the UK where it is underpriced. In fact, let me sneak that in here. And then, of course, we'll sell gold in the US where it is overpriced. Remember, the logic behind any arbitrage is that you want to buy a product where it is underpriced or undervalued and sell it where it is overvalued. That's how you make your money. All right, now, of course, this cannot last forever because in the market where you're buying the gold, the price will go up. In the market where you're selling the gold, the price will go down. And eventually, the price will be the same in both countries. And at that time, the law of one price will be reestablished. Now here, if the gold sells for more than 400 pounds per ounce, we'll buy the gold in the US where it is underpriced and sell it in the UK where it is overpriced. And again, this is the basic logic behind all arbitrage opportunities. But in the process, look what happens. When we buy it in the US, that pushes up the price. When we sell gold in the UK, that pushes down the price. And guess what's going to happen fairly quickly? The two will be equal and the law of one price is the same, or is holding again. Now, this type of arbitrage is a little bit different than what we've seen before. It's called goods arbitrage because it's gold, even though it's technically a financial asset, it is still a commodity which can be used for other purposes. So we'll think of this as goods arbitrage. Now, I'll just mention here as well, one of the problems with goods arbitrage is that the transactions costs needed to carry out the arbitrage wipe out any arbitrage profits. This is a real problem, which helps limit the amount of goods arbitrage that can take place. So, for example, in that last case, suppose that it costs $10 to ship gold between the US and the UK. Then the price in the US and the UK must be different by more than $10 in order for goods arbitrage to be profitable. Okay, so that the gap between the two has to be at least $10. Otherwise, there's no point. So that does limit our ability to carry out goods arbitrage. It's not impossible, but it's a lot more difficult than with financial assets where you don't really have to worry about this. Or at least it's not going to be such a large amount. Now, we all started to talk about here, what about other types of goods, like the Big Mac? Now, I brought this one up because we know now about the McDonald's, or the Economist's Big Mac Index. If instead we're looking at Big Macs, when the exchange rate is $2 a pound, suppose that it costs $4 to buy a Big Mac in the US and £1.50 in the UK, which only translates into $3. So in principle, you would think we could buy Big Macs in the UK and sell them in the US. Oh, but there's a couple of problems there. First of all, there's a problem with them being perishable. And secondly, the cost of shipping is likely to overwhelm any profits we might earn by shipping them back and forth. So, in a case like this, goods arbitrage is extremely unrealistic. And so, for a good like that, we say that it is non traded. In other words, this means that goods arbitrage is not feasible. And for these types of goods, we say that they are non traded. Actually, let me switch this around here. Goods like the Big Mac are referred to as non-traded goods. For these, the law of one price is not likely to hold. And also, I just want to mention here as well, before I forget, in addition, it is unlikely that services can be traded between countries. Okay, so therefore, the law of one price is unlikely to hold for services. So to the extent that the law of one price does not hold, PPP will not hold early either. So the larger the percentage of an economy that is due to non-traded goods and services, the smaller is the likelihood that PPP will actually hold. Now, the Big Mac index actually shows us that this thing is extremely unlikely to hold. In fact, if you go to the Economist website and look at the Big Mac index, what they've done is they've taken all the different countries and said, listen, why don't we actually do this? Let's figure out what the prices are of Big Macs in these different countries and what they should be based on the current exchange rates. And so you can see that most of these countries' currencies are theoretically undervalued relative to the PPP predictions. And you notice the percentages are very, very significant. Very significant. In fact, look how high they go. In Indonesia, the rupiah is considered to be 57.5% undervalued compared to the United States, or compared to what we would expect with PPP. So here, they're saying that a Big Mac costs $3.29 in the Great Britain, $5.66 in the US. Now, the exchange rate here, this is 0.58, which means pounds per dollar. Let me convert that into dollars per pound. All right, so here's the example. Okay, so the Big Mac costs $3.29. In the UK, and according to this, the exchange, oh no, that's the implied exchange rate. The actual, so it says 0.74 in dollars to pounds, that would represent $1.35 per pound. Okay, therefore, the US price should be, and then we'll multiply these together. And that implies that the US price should be $4.45. Instead, the actual US price is, according to this, $5.66. Okay, so what they're saying is that the exchange rate implied by PPP is, so what they're saying is that it shouldn't be so low. The British pound exchange rate should be higher. Okay, how do you know how much higher? Well, this is what you would have to do. You take this expression and replace this 135 with X and set that equal to the actual price in the US, which is 566. So now to solve for X, I'll take all right, 566 over 3.29 pounds. And let's see what that turns out to be. About $1.72 per pound. Okay, so all right, hold on. So in other words, the PPP implied exchange rate is 172 per pound. And the actual exchange rate is $1.35 per pound. So what does that mean? So clearly PPP fails to hold. In fact, it's off by quite a bit. And so what we're saying here is that the difference between the two it should take more dollars to buy a pound, so that the pound is undervalued compared with the dollar. Now, if you look at this chart that they give us, that's true for most of these countries. In fact, virtually all of them are officially undervalued, except for a few. Switzerland, Sweden, and Norway are officially overpriced according to PPP. The vast majority of them are considered to be undervalued according to this theory. So that tells you that maybe this theory isn't so good. All right. So it kind of tells us that maybe we should take this thing with a grain of salt, because in very few cases are we even close. Yeah, Israel is about the closest we're getting. It's only off by 5.5%. And they do this every year, and it's the same thing every year. It's never, very rare that they actually get very close. But remember, the Big Mac is now, as we know, a non-traded good. So of course, why would it hold? If the price is different, there's not a whole lot that we can do about it. All right, so the actual PPP equation looks like this. And so basically, if you rewrite this algebraically, what you're seeing here is that the spot exchange rate, let's say this is dollars per pound, should be P over P star. And of course, in these P in the numerator is the CPI, US price level. And down here we have the British price level, which is RPI. And so we know, based on our observation of the Big Mac index, that clearly this theory is not working very well. Not even close. And it's because primarily, well, there's a few different reasons, but the main reason, and oh, by the way, here's another chart from 2013. Just so you get a feel, they're same thing, they're all way off. It's the existence, it's two things really. It's the existence of these non-traded goods and services, or in fact, it's really the idea that most goods at this point in time are considered to be non-traded, and then we also have a lot of services, more so than ever before. The other thing that can throw this off is trade barriers, because they artificially increase the cost of imported goods, which gives a distorted look at the cost of goods in two different countries. All right. Now, luckily, though, this model or this theory was designed to show price levels explain exchange rates, but a slight variation of this was produced, which shows that instead of thinking about price levels, we should think about inflation differences between the currencies to help determine their strengths. All right, so we'll look at that in a minute, but first I found this video about PPP, which I think you'll find very interesting. This will wrap up everything we've been talking about very nicely. All right, so let's take a look at this. PPP, and what is it for? By the way, it's not completely useless. A lot of studies done with foreign countries actually use this because it's, especially with small countries where they don't trade a great deal with the US, sometimes it's very hard to be sure how accurate their exchange rate information really is. So sometimes this version has to be used to come up with some estimated values. So why don't we take a quick look at this video, and we'll see everything you ever wanted to know about PPP. All right, so let's give this thing a look and let's see how it goes.
Now let's consider the hypothesis of purchasing power.
All right, I guess we're all done. So anyways, I started to say before, we do have this slightly different version of PPP, which seems to work a lot better. It's called relative purchasing power parity. And so here what they've done is they've changed the equation slightly. They've converted it into an equation which shows that an exchange rate strength should depend on the different inflation rates in the two countries. And we call this again relative PPP. And let's take a look at it. So what's happening now is that we're changing all these variables into percentage changes. This is a percentage change. So if you're looking at, for example, the percentage change in the price of a good, then that would mean, let's say the new price of a good minus the original price, or the old price divided by the old price. That's how you would calculate a percentage change. Now, here, this is the percentage change in the CPI. That means that this is US inflation, because that's how it's actually calculated. And that means this is UK inflation. And so this, of course, would be the percentage change in the dollar-pound exchange rate. All right, so how would that work? Okay. Well, it turns out, and I'll tell you now, I mean, I guess maybe we could find a video for this, but it turns out that in practice, this actually works much better than absolute PPP. It does appear that high inflation rates are going to cause a currency to get weaker. In fact, you can tell just by looking at this equation, if the US, for example, if the US inflation rate is greater than it is in the UK, that means that this percentage exchange rate change should be positive, and that implies a weaker dollar. All right, that's what that means. A weaker dollar, because US inflation exceeds UK inflation. And of course, if our inflation is lower, then the dollar should get stronger as a result. Okay, so let's look at a quick example of this. And so suppose that currently the spot exchange rate is $2 a pound. US inflation is only 2% compared to UK inflation of 4%. So the theory says, well, listen, here's what should happen. If you take the US inflation, again, that's this one, and this is UK inflation. And so you get 2 minus 4, you've got minus 2. That means E should go down by 2%, and that means the dollar should appreciate by 2% against the pound, that is, over the coming year. Okay. Now, whether it happens or not is a different story, because this is assuming that nothing else changes. But it is saying that the fact that we have lower inflation in the UK should put pressure on the dollar to get stronger. And in fact, in this case, the drop of 2% would bring it down to $1.96 from $2, meaning a 2% stronger dollar. All right, now we're about to introduce a very important model of exchange rate determination, which explains exchange rates in terms of rates of return, because we're assuming here that investors see exchange rates, or currencies, I should say, as financial assets. So in other words, imagine yourself with the ability to buy stocks or bonds or put your money in the bank. You may decide that a better investment is simply to buy a foreign currency and hope that you'll earn a positive rate of return. How can that happen? That will depend on what interest rate you can earn in that country and if there's any change in the exchange rate. So we'll see some examples of this as we go along. But with this approach, we're assuming that investors see currencies as simply investment vehicles. And in a lot of cases, what ends up happening is that when investors buy foreign currencies, they simply deposit them in foreign bank accounts, hoping to earn a higher rate of interest than they could get in the United States. So the premise of all of this is that investors are always looking for the highest real rate of return when choosing where to keep their funds, how to allocate them between domestic and foreign financial assets. So the magic word there is real. After inflation, I want to know, where am I going to get the highest real rate of return? That will determine which currency I choose to hold. Now, here's how the basic model works. We have four terms here that we have to look at. RD is the domestic rate of interest. RF will be the foreign rate of interest. Now we know that E is the exchange rate. This is quoted as dollars per unit of foreign currency. And then there's one new term here that we haven't seen before, this thing. What is that all about? Aha. Now that's an interesting concept. We're going to make an assumption here that investors have some sense of what they think that exchange rate will look like in the future. And that will help them decide which currency to buy or invest in. So we're going to call this the expected future value of the spot exchange rate. And that's going to have a major impact on which currency we choose to buy. Now, you might say, well, how do you measure this? Well, there's a lot of ways this can happen. There's a lot of surveys that are constantly being done among participants in the foreign exchange markets, where they see what people think will happen to different currencies in the future. We could go by that. There's also several theoretical models that we can use, but we're assuming that investors in this market have a consensus of some kind as to where they see these currencies going in the future. That's the number we'll plug into this formula. In fact, I'm not sure if we can find that information here online. I think it might be proprietary, but let's see what we can do. All right, well, all right, okay. Boy, I don't know. See, here's somebody actually tested, this is 10 years ago. This is the model we're talking about, the asset pricing model of exchange rates with survey data. They're trying to find out if this theory really works or not. But this looks like it's probably a very technical paper. Ooh. Oh boy. Oh yeah, no, this is way out of control. Okay. I thought we could find, well, wait a minute. Survey and exchange rate expectations. Oh no, that's 20 years ago. Hmm. Yeah, I was afraid. I guess we're not going to, it's not the case that we'll just go be able to find a chart on the internet. It doesn't seem to exist, or at least, like I said, it's probably proprietary information. Whoever does this, wait a minute, maybe not. Yeah, so they want you to pay for it. I thought so. But let's assume you have access to this information. You've decided to pay for it, or else you have your own expectations. So, by the way, one more thing I do want to mention is specifically these rates of interest that I mentioned. These are euro currency deposit rates. All right. So the domestic rate, it doesn't mean you're putting your money, let's say, in an American bank. It means you're keeping your money in a euro dollar deposit. And the same thing with the foreign currency. If the foreign currency is, let's say, the Swiss franc, that means this rate is what you're earning by holding euro Swiss franc or keeping your money in a Swiss franc, euro Swiss franc account, I should say. All right. Now, why is this model telling us what it is? In other words, what is the origin of this model? How come it has this form and not another form? Well, if you look at it carefully, really what it's saying is this. In fact, let me copy this to another page. Right here, that'll do. Just as a quick reminder, what is this formula really telling us? The rate of return to the domestic investor holding the domestic currency is simply RD. All right, so if RD, let's say, is euro dollars, the euro dollar rate, then as an American investor, this is the return that an American investor will earn. There's no uncertainty about it. Now, if the American investor is thinking about investing in the foreign currency, there will be two components to the rate of return. First, the actual foreign rate of interest. Okay. But then this is the part that you don't see in the domestic investment. This is the expected percentage appreciation or depreciation of the foreign currencies. In other words, we're not covering this investment with a forward contract. We're going to bear the foreign exchange risk when we invest in this foreign currency. Now, we already know why this is, because we've already seen this. Oh, what's going on here? Here we go. Okay, so note that we will not be using a forward contract to hedge the risk of investing in the foreign currency. This is because, as we've seen, as long as the interest rate parity condition holds, by entering into a forward contract, we are guaranteeing that the rate of return will be the same when investing in the domestic and the foreign currency. So that kind of defeats the whole purpose of investing in the foreign currency. We want to get a higher rate of return. If we hedge our foreign exchange risk with a forward contract, we'll end up with exactly the same rate of return in both currencies. So what was the point? So we're essentially gambling when we buy the foreign currency. We think we can have a higher rate of return here. Now, how does this work? If this term is positive, that means we expect the foreign currency to get stronger, or of course the dollar to depreciate, or let's call it the domestic currency. That, and we'll see in a minute why, that actually makes the rate of return in the foreign currency even higher than it would be for the domestic currency. So if you're an American and you're thinking about investing in British pounds, you hope that the British pound appreciates, because that will actually increase your rate of return in terms of dollars. So this is your signal that yes, jump in there and buy pounds because you'll make more money that way. All right, so don't worry, we'll use a numerical example to prove this. But of course, this works in both directions. In this case, the foreign currency is expected to depreciate, or in other words, the domestic currency or the dollar is expected to appreciate. That, as we'll see, will actually reduce the return to holding the foreign currency. So when you're buying a foreign currency, you're actually hoping that the dollar will get weaker. If it does, it'll increase your rate of return. If it doesn't, you could end up being worse off than if you'd held dollars in the first place. All right, here's the numerical example that proves this. The U.S. investor has the opportunity to invest $1,000 for 1 year in a British bank account that pays 5%. In other words, this is a euro sterling deposit. The exchange rate is $2 per pound. So what happens if we believe, or let's say that our expectation is that in a year from now, the exchange rate is either $1.90 per pound or $2.10 per pound. What will be our rate of return in both cases? Okay, so in the first case, well, either way, we're going to convert our $1,000 into 500 pounds. And since the British the euro sterling deposit rate is 5%, in 1 year, no matter what happens, those 500 pounds will be worth 525 pounds. That's not the tricky part. If our first scenario is correct, in other words, a stronger dollar, when we bring those pounds back into dollars, we're only going to get $997.50. So we're actually losing money here. Wow, that's pretty scary. The idea is that, yes, we have 525 pounds, but because the dollar is so much stronger, our actual return is a loss of 0.25%. But on the other hand, what if we expect a weaker dollar in the future? 210, for example. What does that do to our rate of return? Well, that makes a staggering amount of difference. Look at this. All of a sudden, instead of getting less than $1,000, we're getting 1,102.50. The expected return now is 10.25%. So that would be the case when you really want to invest in the UK, because you're not likely to get that rate of return in the United States. But the problem here is that your expectations could be wrong. So this is a bit of a gamble. This is not an arbitrage. But if you're really pessimistic about the dollar, that would be the ideal opportunity to invest in the pound. All right, so once again, with a weaker dollar, that significantly increases our rate of return to holding British pounds. And so when you look at the returns to holding that foreign currency, you're getting two things going on here. You've got the return to the foreign currency itself, the interest rate, and this piece, which is going to bring you either more or less return depending on which direction it goes. So when you buy that foreign currency, you don't know for a fact what the actual return will be. So we can think of this, like I said before, as the expected return to holding the foreign currency, because that is not known with certainty. And so the key word there is expected. It's not known with certainty like the dollar return is by holding euro dollars. And so this part will be driven by expectations of market participants. And those expectations can change very quickly, as we'll see. So now, when you look at this whole equation brought together again, you'll see that what you really have here is an equilibrium condition. Okay, what does that mean? Okay, so once again, this is the condition we had earlier. RD equals RF plus this expression. So what we're saying there is that in equilibrium, the return to the domestic currency equals the expected return to the foreign currency. Okay, if not, if this condition fails to hold, then what you would expect is that people will shift their funds around. They may take their euro dollars and trade them for euro sterling, or they may do the opposite until everybody's satisfied again, at which point we've restored the equilibrium exchange rate. So this is not an arbitrage, it's an equilibrium condition. And when something changes, there'll be a reaction by investors who will shift their funds from one currency to the other until this condition is reestablished. All right, so now the examples that we're about to look at are, they're not that horribly complicated, but we're going to go through step by step and see where this model is actually coming from. So I'll tell you what, since it's Thursday and we're having a long, sort of a long weekend coming up, why don't we stop right here? And in the meantime, don't forget, our intention is to go over the sample midterm next Monday. So don't forget, it's right here on Moodle. And so I'd like to go over that next Monday so that we can then have our actual midterm sooner rather than later. All right, so don't forget about that. So between now and then, take a look at the sample midterm. You'll see it's very similar to what we've been doing in the first or the chapters 2 through 5. Okay. Other than that, I think we're had enough for one day. And why don't we stop right here? And I'll see you all again next Monday.
Thank you. Have a good weekend.
Okay. See you later. All right. Bye.
Hi, Professor.
Yes. Hi.